Welcome to the deep dive. We pull apart complex reports, filter out the noise, and deliver the concentrated knowledge you need. Today, we're undertaking, an intensive analysis of the Q1 fiscal year 2026 earnings presentation for Pedialyte Industries Limited. The massive company behind brands like Fevicol, Dr. Fixit, Feviquick, global names, really. Our mission here isn't just, reporting the numbers. It's about understanding the strategy behind them. This presentation, it gives us a pretty clear look at how a dominant market leader manages not just volume growth, but also margin expansion, especially in today's dynamic consumer environment. It's sort of an insight into the operational health of a company that many see as a proxy for the Indian construction and home improvement economy.
That's exactly right. And for you listening, we're really honing in on the essential nuggets of knowledge here. We're going beyond just net sales to focus on, I'd say, three critical areas. First, that remarkable jump in profitability. We need to understand how they manage that operational leverage. Second, the segmentation of volume growth, especially the difference between the consumer side, C&B, and the industrial B2B segments. And finally, those massive strategic moves they made, rewarding shareholders, commemorating the founder's anniversary. Big stuff.
And the headline hook is pretty simple, isn't it? Revenue growth was strong, yeah, absolutely, but profitability just soared at a much faster rate. That efficiency story, it really sets the stage for a dramatic corporate action that we definitely need to unpack. Okay, let's get into this. Let's start with the consolidated scorecard for Q1 FY26. So we saw net sales coming in at the Rs 3,742 interlocutor. That reflects a solid 10.6% year-over-year growth. It's a strong top line, no doubt.
It is, yeah. But the real story, like you said, is the operating leverage. I mean, when we look at the efficiency metrics, consolidated EBITDA reached Rs 941 crore. Now that represents an even stronger growth of 15.8% year over year. This difference, this disparity, it's key. Because it allowed the profit after tax, or PAT, to jump by a really impressive 18.7%.
Right, that divergence. The bottom line growing almost, 8 percentage points faster than the top line. That suggests, that pricing power and input cost management are really hitting home in a big way for them.
Precisely, and we can actually quantify that efficiency by looking at the margins. Consolidated EBITDA margins improved by 101 basis points over Q1 FY25. They reached 25.6%. Now, for those listening who might not track these daily, a basis point is just 1/100th of a percentage point. So we're talking about a full 1% increase in operational margin in just one quarter. This is a very clear marker of operational discipline and, frankly, the kind of market dominance that lets them pass on costs effectively when they need to.
Yeah, makes sense. And the domestic performance, the standalone results, they pretty much mirrored these consolidated figures closely, didn't they? 10.6% net sales growth and 17.8% PPT growth. It just confirms that the core Indian market is really driving this margin momentum.
Okay, now let's pivot a bit. From the monetary figures to the demand figures volume. What drove that strong revenue? Well, the overall underlying volume growth, or UVG, that strips out the effect of price increases, It was robust at 9.9% across all categories and geographies. That's very close to double-digit volume growth, which suggests they aren't just capturing market growth, but potentially taking market share too.
Okay, let's break down the two main engines of the company then, starting with the colossal segment. Consumer and Bazaar, or C&B. This is the segment with all those everyday high-recognition brands, Fevicol, M-Seal, Dr. Fixit, and it's the engine that really powers the business. It represents over 81% of total standalone sales. That's huge.
And this engine is incredibly efficient. The C&B segment reported a solid UVG of 9.3%, which is also showing sequential improvement, by the way. Sales grew by 10.2% to Rs 2,818 crore. But let's look at why this segment generates such premium returns. The PBIT margin for C&B, it jumped from 30.5% in the year-ago quarter to an astounding 32.1%.
Hold on, a 32.1% PBIT margin. That's exceptional for a manufacturing company in this space. How do they keep that level of profitability?
It's the product mix. That's a key nugget from the presentation, actually. While Dr. Fixit, the construction and paint chemicals part, is significant, yeah? The bulk of their high-margin business, it really lies in adhesives and sealants. That makes up 53.2% of their total standalone sales. These are often small-ticket, high-recurrence products where brand loyalty matters immensely. It allows them to maintain pricing discipline and those premium margins against, smaller regional competition.
Right, that distinction is crucial. Okay, now let's look at the other side, the business-to-business or B2B segment. This deals in industrial adhesives, bulk products. They actually reported the strongest volume growth of the two, didn't they? UVG at 12.6%. That points to a major acceleration in maybe the industrial and construction cycles.
Absolutely. That 12.6% volume growth is a powerful indicator. real momentum in commercial and infrastructure projects. Their sales grew by 11.6% to our 702 crore, and their margin story is also improving. The B2B PBIT margin increased from 17.0% to 18.7%. So if we look at the total profitability across the board, the PBIT growth rates 16.1% for C&B and an accelerated 23.1% for B2B. They significantly outperform sales growth. It shows that strong operational leverage isn't just a C&B story, it's company-wide.
That impressive domestic margin achievement, it really sets the stage for the next section, doesn't it? The company's growth accelerators.
Plus the subsidiaries.
Let's dig into the subsidiaries because the cost dynamics here seem to have played out a bit differently than in the core business.
They certainly did, yeah. The domestic subsidiaries reported sales growth of 11.5%. But the profitability explosion, that was startling. EBITDA grew by a massive 31.7% year over year, just huge. That pushed the EBITDA margin to 11.9%. And the presentation was pretty clear on the reason. This sharp rise was largely driven by the softening of key material costs.
Ah, okay. So the immediate benefit of lower raw material prices went straight to the subsidiary bottom line. It demonstrates a very quick ability to translate those input cost savings into earnings. What about the global picture? How did that look?
International operations delivered, well, solid, consistent growth. Revenue grew 6.4% and EBITDA grew 9.0%. So that showed margin improvements about 34 basis points. It wasn't quite the spectacular jump we saw domestically, no, but it's steady, especially when you consider all the geopolitical volatility out there.
Right, good point. If we do a quick regional deep dive, maybe using constant currency figures, where was the strongest international performance concentrated?
The highest growth pockets were clearly Asia and the Middle East and Africa. Asia saw 7% sales growth, but that was coupled with a significant 32% EBITDA growth. Big jump on the profit side. Meanwhile, the Middle East and Africa segment delivered 5% sales growth, paired with 27% EBITDA growth. So this suggests that while their presence in these markets is maturing, they're gaining, significant operational control and really optimizing their supply chains in those regions.
Okay, so when a company reports this kind of dual success, robust volume growth and massive margin expansion, it really sets the stage for management to make a statement. And they certainly did, didn't they? With that major corporate action taken on August 6, 2025, which coincided with the commemoration of the 101st birth anniversary of the founder, Shri B.K. Parekh.
Exactly. This announcement is subject to shareholder approval, of course, but it was twofold. First, they announced a special interim dividend of Rs10 per share, which is, a substantial reward. It signals immediate financial health.
Yeah, definitely sends a strong signal. But the truly strategic move, I think, was the bonus issue. They announced a bonus issue of one fully paid bonus equity share for every one fully paid equity share held. A 1.1 bonus. That essentially doubles the number of outstanding shares for existing holders, right?
Right. And this is more than just a reward. It's a strategic decision. I mean, while a bonus issue doesn't fundamentally change the company's valuation, it has significant implications for market psychology and liquidity. By doubling the shares, the per-share price is effectively halved. This makes the stock feel more accessible, maybe more psychologically appealing, to a wider base of retail investors. Those who might see a high nominal share price as a barrier to entry.
Ah, okay. That makes sense. And it contextualizes their consistent track record of shareholder returns, too. The presentation noted their history of steady payouts, referencing a dividend payout ratio that reached, 48.6% in FY25. So the 1.1 bonus issue solidifies that commitment while also improving market access.
Interesting. Exactly. So, as we transition now to the forward outlook, the management synthesizes the future by stating they remain cautiously optimistic. And this does raise an important question, doesn't it? If your domestic segment is roaring, volume growth is stellar, input costs are favorable, why use the word cautious? Are the global headwinds really enough to offset nearly 10% domestic volume growth? It's worth asking.
Okay, let's start with the optimistic part then, the domestic tailwinds they seem to be banking on. They're looking at continued domestic growth driven by, favorable monsoon forecasts that usually means better rural demand. Also, steady demand conditions in construction and real estate and favorable monetary policy, citing lower interest rates and recent measures to improve liquidity. Seems reasonable.
It does. However, the caution is absolutely warranted when you consider the global exposure. They specifically highlight geopolitical developments and the likely impact those could have on supply chain disruptions. Even if your raw material costs are low now, disruptions can rapidly change that equation. Global tariffs also introduce significant uncertainty. That affects not only their export revenues, but also the stability of their international subsidiary operations.
Right, so their strategy is maybe a bit defensive, despite the fantastic results. They remain committed to their core strategic agenda, delivering consistent, profitable, volume-led growth. That phrase seems key. Through targeted investment in brands, supply chain modernization, and their people, basically focusing on the things they can control, while acknowledging the volatile macro environment they can't.
That's really the essence of the presentation, I think. Maximizing internal efficiency while being prepared for external instability.
Okay, so let's try and synthesize this deep dive into Pedialyte's Q1 FY26 performance. We saw a powerful blend of financial strength, right? Evidenced by that 18.7% campaign growth. Operational discipline, seen in the volume growth nearing 10% and that margin expansion across segments. And a major strategic move to enhance shareholder value through the 1.1 bonus and the special dividend.
Yeah, the underlying health of the business seems undeniable, driven fundamentally by the high-margin, sticky nature of those adhesives and sealants products, which, as we noted, dominate the consumer and bazaar segment. They've effectively mastered the relationship with both the consumer and the contractor over decades.
So what does this all mean for you listening in as you track this industry and these market leaders?
Well, here's a thought. Given that 81% of sales come from that C&B segment, a segment built on decades of, let's be honest, award-winning, often humorous, very localized brand building, and deep grassroots contact with end users, what role will the accelerating focus on digital connection play? They mentioned celebrating occasions digitally. How will that maintain dominant market share against future disruption? How quickly can a company built on physical distribution and really emotional advertising pivot? How quickly can they pivot to maintain that stickiness in an increasingly digital consumption landscape? That's something for you to explore as they navigate the next phase of growth.